Picture this, October 1907. In just 3 weeks, the New York Stock Exchange loses nearly half its value. Lines of desperate people stretch around city blocks, waiting outside banks to withdraw their life savings before the doors close forever. America's third largest trust company collapses in a single day after panicked depositors withdraw $8 million in cash. That's equivalent to roughly $250 million today. The economy is in free fall. There's no Federal Reserve, no deposit insurance, no safety net whatsoever. And the only thing standing between America and complete financial collapse is a 70-year-old banker working from his private library on Madison Avenue. One man, J.P. Morgan. He'll personally organize the rescue of the entire American economy, strong-arming other bankers into emergency loans, keeping the stock exchange open through sheer force of will, and literally locking Wall Street's most powerful men in a room until they agree to his rescue plan. But here's what's truly remarkable. This wasn't supposed to be Morgan's job. And the reason one private citizen had to save the country's economy? That's the economic story most of America slept through. If you're fascinated by the hidden economic stories that shaped our world, the financial events that happened while everyone else wasn't paying attention, hit that like button and subscribe to The Sleeping Economist. Chapter 1. The Copper King's Gamble. To understand how America's financial system nearly collapsed in 1907, we need to travel back 1 year earlier to the copper mines of Montana. There, a brash entrepreneur named Augustus Heinze had just pulled off one of the greatest business coups in American history. He'd been fighting legal battles against the massive Anaconda Copper Company for years, outmaneuvering them in court, stealing their richest mining claims through clever legal loopholes, and eventually forcing them to buy him out just to end the warfare. In 1906, they paid him $12 million, about $380 million in today's money, for his mining interests. Heinze was 37 years old, fantastically wealthy, and convinced of his own brilliance. He moved to New York City with big ambitions. He bought control of several banks, including the Mercantile National Bank. His partner in these ventures was Charles W. Morse, another aggressive businessman who'd made his fortune in shipping and was known on Wall Street as the Ice King for cornering the ice market in New York City. Together, Heinze and Morse represented a new breed of businessman in early 1900s America, aggressive, interconnected, and willing to bend rules to make spectacular profits. They used deposits from their own banks to finance risky stock speculation schemes. They sat on each other's boards of directors. They loaned money to themselves and their associates with little oversight. This kind of self-dealing was technically legal, but it was exactly the sort of behavior that made the entire financial system fragile. By October 1907, Heinze had his eyes on an even bigger prize, United Copper Company. His brother Otto was convinced that a group of investors had been short-selling United Copper stock, betting that the price would fall. If the Heinze brothers could buy up enough shares, they could trigger what's called a corner. Here's how it works. Short sellers borrow shares and sell them, hoping to buy them back later at a lower price. But if someone corners the market by owning most of the shares, short sellers have nowhere to buy them back except from the person who owns them all. The corner owner can then demand any price they want. It's like owning all the houses on a monopoly board. You set the rules. The Heinze brothers borrowed millions from the Knickerbocker Trust company and other institutions. Starting on Monday, October 14, 1907, they began aggressively buying United Copper stock. The price shot up from $39 to $60 per share in just 1 day. On Tuesday, October 15th, Otto Heinze called in the short sellers, demanding they return the borrowed shares. This was the moment of truth. The corner would either make them spectacularly rich or destroy them completely. Chapter 2. The corner collapses. What the Heinze brothers didn't know, what they couldn't have known, was that they dramatically miscalculated. There weren't nearly as many short sellers as they'd thought. And worse, there were far more United Copper shares available than they'd anticipated. When Otto called in the shorts on October 15th, the short sellers simply bought shares from other sources. The Heinzes didn't control the market. They just spent millions buying a stock that was about to crash. By Wednesday, October 16th, United Copper stock had collapsed from $60 to $10 per share. The Heinze brothers were wiped out. They'd borrowed millions they couldn't repay. And those loans had come from banks and trust companies they controlled. Within hours, the Otto Heinze brokerage firm closed its doors. Word spread through Wall Street like wildfire. The Heinzes were finished, and any bank connected to them was in trouble. Here's where the domino effect began. In 1907, banking operated on trust and perception. Banks didn't hold all their depositors' money in a vault. They loaned most of it out, keeping only a small reserve on hand. National banks were required to keep about 25% in reserve. But trust competes, a different type of financial institution that competed with banks for deposits, only kept about 5% in reserve. This meant they were far more vulnerable to what bankers fear most: a bank run. A bank run happens when depositors lose confidence and rush to withdraw their money all at once. If everyone wants their cash simultaneously, even a perfectly healthy bank will fail because most of the money simply isn't there. It's been loaned out to borrowers. Banking works only when people trust the system enough to leave their money deposited. On Thursday, October 17th, depositors began lining up outside the Mercantile National Bank Heinze's bank. The line stretched around the block. People who'd heard about the United Copper disaster wanted their money out before the bank collapsed. By Friday, the panic had spread to other Heinze-associated banks. Newspapers were publishing lists of which banks the Heinze brothers controlled. Depositors pulled out over $8 million in a single day. The New York Clearinghouse, a private association of the city's major banks, stepped in. They examined Mercantile National Bank's books and announced publicly that it was solvent. But they demanded a price. Heinze and Morse had to resign from all their positions. They had to completely sever ties with their banks. The Clearinghouse then provided emergency loans through a mechanism called Clearinghouse Loan Certificates, which were essentially IOUs backed by the association's member banks. This intervention worked for the national banks. By Monday, October 21st, the runs on Heinze's banks had stopped. Depositors' confidence was restored. The crisis seemed to be over. Wall Street breathed a collective sigh of relief. But what they didn't realize was that the real panic, the one that would bring America's economy to its knees, was just beginning. Chapter 3. Knickerbocker Falls. The problem was trust companies. These institutions had grown explosively in the early 1900s. They offered higher interest rates than traditional banks because they took more risks and kept less cash in reserve. Trust companies had become deeply involved in stock market speculation, making uncollateralized loans to brokers that allowed daily trading on the New York Stock Exchange. They were, in modern terms, the shadow banks of 1907, operating outside the traditional banking system, but deeply connected to it. The largest and most prestigious of these was the Knickerbocker Trust Company, New York's third largest financial institution. And on Friday, October 18th, the newspapers reported that Knickerbocker's president, Charles T. Barney, was an associate of Charles Morse, the same Morse who'd just been forced out of his banks. The news hit like a bomb. Whether or not Barney had actually been involved in the United Copper scheme didn't matter. Perception was reality. By Saturday morning, depositors were lining up outside Knickerbocker Trust's headquarters at 5th Avenue and 34th Street. The line wrapped around the block. People waited for hours in the cold, desperate to withdraw their deposits before the trust collapsed. Knickerbocker's management requested help from the New York Clearinghouse. It's the same organization that had saved the Heinze banks. But the Clearinghouse refused. Knickerbocker wasn't a member trust companies operated outside the Clearinghouse system. The association's resources were reserved for its own members. Next, Knickerbocker turned to J.P. Morgan, the most powerful banker in America. Morgan was 70 years old, semi-retired, and had just returned from a religious convention in Richmond, Virginia. He asked Benjamin Strong, a vice president at Bankers Trust, and later the first head of the Federal Reserve Bank of New York, to examine Knickerbocker's books over the weekend. Strong worked through Sunday night, but Knickerbocker's records were too complex to evaluate in such a short time. He couldn't determine whether the trust was truly solvent or just temporarily illiquid. Without certainty, Morgan refused to help. It was too risky. On Monday, October 21st, Knickerbocker's board of directors fired Charles Barney. The National Bank of Commerce, which had been processing Knickerbocker's checks, announced it would no longer serve as the trust's clearing agent. These announcements were meant to restore confidence. Instead, they sparked absolute panic. On Tuesday, October 22nd, the lines outside Knickerbocker were massive. Depositors withdrew money as fast as tellers could hand it over. By early afternoon, nearly $8 million, roughly 60% of the trust's deposits had been withdrawn. At 2:30 p.m., Knickerbocker's vice president walked out to the waiting crowd and announced the trust was suspending operations. The doors closed. People still in line would not get their money. Many lost their life savings in a single afternoon. And that's when the real crisis began. Chapter 4. The panic spreads. The suspension of Knickerbocker Trust created a citywide financial panic. If the third largest trust in New York could fail, then no trust company was safe. The depositors rushed to withdraw money from every trust in the city. The Trust Company of America faced the most severe run. Lines formed before dawn. Tellers worked frantically, but the crowds kept growing. The stock market went haywire. The call money rate, the interest rate on overnight loans that made stock trading possible, had been around 10% before the crisis. On October 22nd, the day Knickerbocker closed, it spiked to 70%. 2 days later, it hit 100% annually. At times, no money was available at any interest rate. The stock market couldn't function without these overnight loans. Brokers couldn't buy or sell. Prices plummeted. This is when JP Morgan changed his mind. The entire financial system was collapsing. Something had to be done. Morgan had retired from day-to-day banking operations, but now he essentially came out of retirement to save American capitalism. He set up command headquarters in his private library on Madison Avenue, the same building that's now the Morgan Library and Museum. Morgan organized a coalition of New York's wealthiest men. He strong-armed them into providing emergency loans. When the Trust Company of America ran out of cash, Morgan personally arranged for money to be rushed across town. When the New York Stock Exchange was about to close early due to lack of credit, Morgan summoned the presidents of major banks and trust companies to his library and demanded they provide $25 million immediately to keep the exchange open. According to witnesses, he told them, "This is the place to stop the trouble, then it won't go any further." The money was raised in under 15 minutes. But even Morgan's efforts couldn't stop the contagion. Panic had spread beyond New York. Banks in other cities began restricting cash withdrawals, trying to preserve their reserves. In the absence of a central bank, there was no coordinated response. Each institution acted in its own self-interest, which made the overall crisis worse. By late October, the U.S. Treasury Department got involved. Treasury Secretary George Cortelyou traveled to New York and deposited $25 million of government funds into national banks to provide liquidity. But it wasn't enough. On Saturday, October 26th, the New York Clearing House made a dramatic decision. Member banks would restrict convertibility. This meant that deposits could not be freely converted to cash at par value. It was essentially an admission that the banking system couldn't meet withdrawal demands. The cash premium, emerged cash, was literally more valuable than a bank deposit. To get a $100 bill, you might have to withdraw $104 from your account. This restriction had one beneficial side effect. It prompted massive gold imports from Europe. Now, when cash trades at a premium, it becomes profitable to ship gold to New York and exchange it for dollars. Chapter 5. The aftermath, the panic of 1907, didn't end with a single dramatic moment. It slowly burned itself out over weeks as gold shipments arrived. Confidence gradually returned. And Morgan's coalition held the financial system together through sheer determination. The worst of the panic ended in mid-November, but the economic damage was severe and long-lasting. The stock market had fallen by nearly 50% from its pre-crisis peak. Industrial production dropped by 17% in 1908. Real GNP, the total value of goods and services produced in America, fell by 12%. Unemployment soared. It was the worst economic downturn America had experienced since the long depression of the 1870s. Only the Great Depression, which would come 2 decades later, would be more severe. But unlike the Great Depression, recovery came relatively quickly. By mid-1908, the economy was growing again. The financial system had been badly shaken, but not destroyed. And the reasons for this faster recovery were instructive. The crisis had been primarily about liquidity and confidence, not fundamental economic problems. Once cash returned to the system, and people believed banks were safe again, normal economic activity resumed. For the trust companies, however, the damage was permanent. Many failed outright. Others were absorbed by banks or dramatically scaled back their operations. Trust companies had been responsible for the crisis, and public trust in them, ironically, had been destroyed. The sector never fully recovered its prominence. Individual stories from the crisis were tragic. Charles Barney, the fired president of Knickerbocker Trust, fell into deep depression. He shot himself a few weeks after the crisis, convinced his reputation had been destroyed unfairly. Augustus Heinze, the man whose copper corner had started the chain of events, was indicted on fraud charges. Though he was eventually acquitted, his fortune and reputation were gone. He died in 1914 at age 44, broke and largely forgotten. The panic also had international repercussions. It was the first truly global financial crisis of the 20th century. European banks that had invested in American securities suffered losses. The interconnectedness of financial markets meant that a crisis in New York had ripple effects worldwide. This global dimension of the panic alarmed policymakers and economists who realized that financial contagion could now spread across oceans in days through telegraph communications and international banking connections. But the most important aftermath of the panic of 1907 wasn't economic hit, was political. The crisis had exposed fatal flaws in America's financial system. The nation had no central bank, no lender of last resort, no coordinated monetary policy. When crisis struck, the entire system depended on the goodwill of one elderly private banker. What would happen when J.P. Morgan was gone? What if he'd refused to help? What if he'd been traveling abroad when the crisis hit? These questions haunted American policymakers and business leaders. The panic had made it painfully clear. America needed a central bank. Chapter 6. The Birth of the Fed. The movement to create a central bank had existed before 1907, but it had always faced fierce political resistance. Many Americans, especially farmers in rural communities, distrusted big banks and feared that a central bank would be controlled by Wall Street elites. They remembered the Second Bank of the United States, which President Andrew Jackson had destroyed in the 1830s, precisely because he believed it represented concentrated financial power. But the panic of 1907 changed the political calculus. It wasn't just bankers demanding reform anymore. It was everyone. Congress established the National Monetary Commission in 1908 to study the problem and recommend solutions. Senator Nelson Aldrich led the commission on a 2-year tour of European central banks. Studying how they managed monetary policy and responded to crises, the commission's work led to the Aldrich Plan, which proposed a central banking system for America. But the plan was controversial. Many believed it gave too much power to private banks. When Democrats gained control of Congress and Woodrow Wilson won the presidency in 1912, the Aldrich Plan was set aside in favor of a different approach, the Federal Reserve System. The Federal Reserve Act was signed into law on December 23, 1913, 6 years after the panic. Created a decentralized central bank with 12 regional Federal Reserve banks coordinated by a Federal Reserve Board in Washington. This structure was a compromise between those who wanted a powerful central bank like the Bank of England and those who feared concentrated financial power. The Fed's core purpose was to prevent exactly what had happened in 1907. It would serve as a lender of last resort during financial crises, providing emergency loans to banks facing temporary liquidity problems. It would regulate the money supply to prevent the credit crunches that turned recessions into panics. The Panic of 1907 teaches us that financial systems are built on confidence, and confidence can evaporate almost instantly. It shows us that interconnected institutions create systemic risk. When trust companies failed, they brought down banks and brokers with them. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel. Because we're just getting started with these financial, educational mysteries.